To our recorded discussion. I'm your professor, Rebecca R. Paquin. So here, our learning objective is to discuss the nature, purpose, and type of derivatives. And of course, we need to apply the recognition and measurement criteria in accounting for derivatives. Okay. So first is, what is derivative? Derivative is a financial instrument whose value changes in response to the change in underlying variable. So it requires no initial investment or a very small one, and to be settled at the future date. So as defined by ESPlus.com. So now derivatives are becoming increasingly common, but sometimes it's very complicated. And why company use derivative? So we know that maraming mga risk, no, on the business when you are investing into a business. So there are some risks that you need to be aware, and you need to settle with. So first is, let's define muna, no, the characteristics of the derivative. So derivative is a financial instrument with all three of the following characteristics. So we have the value of the derivative change in response to the change in the underlying variable. Okay, so when we say underlying, this is a specific interest rate. It could be a commodity price, it could be a foreign exchange rate, price index, and another variable. So although it is not mentioned specifically, derivative must contain a notional, which could be an amount of currency, number of shares, or number of units, or volume. Okay, so take note, the value of derivative changes, no, because of fluctuations, especially uh, in the currency. Okay. Second characteristic of the derivative is the derivative requires either no initial net investment or an initial investment. In other words, there is no payment, or there is only a small payment for the derivative on the date of the contract. So it is not the whole amount of the underlying variable. So usually that is lesser amount, no, on that underlying variable. The third characteristic is the derivative is readily settled at a future date by a net cash payment. So that's it. So, and then, so let's go first to the, okay, so what is the purpose of derivative? So derivative is for managing financial risk. So there are many risks, no, especially if you are into business. So we have price risk, we have credit risk, interest rate risk, impact of the foreign currency risk. Okay, so when you say price risk, this is the uncertainty about the future price of the asset. Credit risk, the uncertainty over whether a counterparty or the party on the other side of the contract will honor the terms of the contract. So example, we have the banks. Then we have the interest rate risk, the uncertainty about future interest rates and their impact on cash flow and the fair value of the financial instruments. And we have also the foreign currency risk, which is the uncertainty about future Philippine peso cash flows stemming from assets and liabilities denominated in the foreign currency. So this derivative will offset, though, the risk that will be encountered, especially the hedge item is exposed, no, in the foreign currency transactions. Okay. Derivatives are used for hedging. So hedging means designating one or more hedging instruments so that the change in fair value or cash flow is an offset in whole or in part to the change in fair value or cash flow of a hedge item. So we have two terminologies here, the hedging instrument and the hedge item. So for example, the company borrow, or say the company borrowed a loan from First Bank, no? Meron siyang na-borrow na loan, let's say 5 million loan, okay? And that is subject for 10% interest, okay? Okay. So this is the hedge item, the interest. And then since this is exposed to uncertainty, it may be increased or decreased, no, at some future time, and then you need to pay this loan in the future. So we don't know, no, what will happen in the future. So the company will buy an hedging instrument, which is the derivative, no, which could be offset on the change of the fair value of your cash flow hedge. So meaning maiwasan yung interest rate risk. So that's for interest rate swap. And then another one is for forward contracts. So for example, uh, you have your materials that are needed, no, in the future, and or you will buy an equipment in the future, and then this is coming from the other country. So there is risk of foreign currency risk, or there is a risk on the credit risk, no, or anything, no. So the hedge item there is your obligation, the hedge item, your obligation to pay that particular amount. So you want to offset if ever there are losses, no, on your obligation or on your asset. So you will go for contracts, forward contract or future contract, to a third party just to offset the changes in the fair value of your hedge items. I hope you understand that one. So what are the examples of derivatives? So derivatives enumerates as follows. We have the future contract, the option, the forward contracts, and the interest rate swap. Okay, now let's go to the measurement of derivatives. An entity shall recognize and measure all derivatives as either assets or liabilities at fair value. But both the fair value and the notional shall be fully disclosed. So it must be disclosed in the notes to the financial statement. A gain or loss is recognized when there is a change in the fair value. Okay, whether the change in fair value is recognized in profit or loss or in other comprehensive income depends on the following situation. So first is if designated as a hedging instrument, if it is not designated as a hedging instrument. The second is if it is designated as a cash flow hedge, and the third is if it is designated as a fair value hedge. So, for no hedging designation of derivative, changes in the um, changes in the fair value of a derivative is not designated as hedging instrument. Also, if there are changes, it will be recognized in the profit or loss because the derivative is more on speculation only. Next, for the cash flow hedge, there are difference on the cash flow hedge and the fair value hedge. So what is cash flow hedge? Cash flow hedge is a derivative that offsets in whole or in part the variability in cash flows, or variability in cash. So take note of that, from a probable forecast transaction. While fair value hedge is a derivative that offset in whole or in part the change in the fair value of an asset or liability. So how we will uh, put that in our profit, or either profit or loss, or either on comprehensive income. So let's look on the gain and loss of the fair value. So for cash flow hedge, the derivative or hedging instrument is measured at the fair value. The change in the fair value is recognized as component of other comprehensive income to the extent that the hedge is effective. If the hedge is ineffective, the ineffective portion is recognized as profit or loss. The hedge item is not adjusted to conform with the fair value. While for the fair value hedge, the derivative or hedging instrument is of course measured at fair value. The hedge item, the hedge item is also measured at fair value, which is not adjusted in the cash flow hedge. Okay? Okay. The changes in fair value are recognized in profit or loss. So, I hope klaro na siya. I will discuss first in the forward contract. Hindi muna ako mag-discuss sa interest receivable, interest rate swap. I-discuss ko yun using the SIM. Okay? So, forward contract is a private contract. So, this is designated as a cash flow hedge, not a fair value hedge. Okay? So, this is an agreement to purchase or sell a specified commodity or foreign currency at specified price with a settlement on the future date at a specified price. So, here, if the market price, so if we are on the buyer side, if the market price is higher than the underlying price, the company will record a forward contract receivable and an unrealized gain forward contract. And then on the date of the actual purchases is recorded equal to the market price, and the unrealized gain forward contract is to be closed by deducting it from the purchases. So let's go to our illustration. So in January 120A, GEM Company expects to make a purchase of 100,000 kilos of a commodity. And then kailan siya mag-purchase sa January 31. So, nag-expect na siya na mag-purchase siya ng commodity on January 31, 20B on the next year, the following year, at the prevailing market price. So, as a protection against the variability of the market price, so usually this is galing from abroad, no? Or mga kuano. Okay, so GEM Company entered into a forward contract with a speculator bank at 150, and the excess is paid by the bank, while if the market price drop, kung mag-drop, GEM Company will pay the bank for the difference. So the market price of the commodity on December 31, 20A is at 170, and on January 31, 20B is at 175. So take note, binili niya noon ng 150, no? The speculator bank at 150. So, let's look on our entries. So, on December 31, 20A, since 150 yun, ang ating 150 yung forward contract natin. Ang market price naman natin on December 31, 20A is 170. So, 170 minus 150. So, there is a difference of 20, no? There is a difference of 20. So, take note, we are the, tayo yung buyer, no? Kasi we want to purchase. So, the market price of the commodity increased to 170, and then yung forward contract natin at 150, meaning nakaginansya ta. So, 170 minus 150, so 20 times 100,000 kilos. Okay, so that is forward contract receivable 2 million and unrealized gain from forward contract 2 million. Okay, next. Sa January 31, okay, you buy na, magbayad naman ta ini, no? Magbayad na ta, magpalit na ta og we will purchase the commodity. Okay? And then the price of the contract is the market price is 175. So, mas nakaginansya pa noon, no? So, 175 that minus 150, 25 times 100, 2,500,000, no? Pero naamang buti unrealized gain before nga 2 million. So, ang ating increase of our unrealized gain of forward contract is 500,000 only, no? Kay because of na-record natin unrealized gain sa December 31, 20A, meron tayong 2 million, nag-increase ng 2,500,000. So, meron pa tayong additional receivable of 500. Okay? And then, naka-receive tayo ni, no? From the speculator bank. Hindi sinabi ang speculator bank. So, we receive from the speculator bank 2,500,000. Okay, so i-close natin ang ating forward contract receivable. 2,500,000 at market price. So, 175 times 100. Okay, and then, mag-purchase na dayon ta. Okay, 175 times 100,000. So, that is 17,500. Okay, so i-close din natin yung unrealized gain forward contract. So, yung purchases talaga natin is not 17,500,000, but 17,500,000 minus 2,500,000 is 15 million, no? Which is na ano ta sa ating katong 150 yun ng katong from forward contract, no? So our purchases on December 20B, no, is 17,500,000 minus 2,500,000 is 15 million. Okay? So naka-receive ta ng nakaginansya ta. Meron tayong gain. Meron tayong na-receive na cash amounting to 2,500,000. Okay? Sige. Now, let's go. Okay, so now let's go to future contract. So, future contract is similar to forward contract. However, this one is traded in future exchange market. Remember, yung forward contract is private contract, while this one is public, no, traded in public. So the parties do not know who is on the other side of the contract. Okay, so let's go to our illustration. The Arno company uses 150,000 kilos of fruit juice. Okay, concentrate each month. On December 31, it entered into future contract to purchase 150,000 kilos on February 120B at a fixed price of 50 per kilo. This is the fixed. Market price on December 31 nag-increase ng 60 and on February 1 nag-increase ng 52. So take note, we are the purchaser here. So if there is an increase, so there is parang ginansya, unrealized gain. Okay, so let's look on December 31, 20A. So yung market price natin December 31, 20A is 60. So we have unrealized gain of 1,500,000. How we get it? 60 minus 50, so that is 10 times 150,000 kilos, so 1,500,000. So take note, yung unrealized gain natin dito is part of the other comprehensive income because this is a cash flow hedge. And then on February 1, our market price is 52. We will purchase it already, no? So February 120B purchases at 52 market price and then cash. And then maka-receive tayo from our speculator kasi nag-increase ng 2 pesos. So 52 minus 50, our fixed price is 50. So 2 times 150,000 kilos. So we receive cash of 300,000 and then na minus sa ating receivable na 300,000. Okay? So, meron tayong kinisya unrealized gain po din, no? I-close natin 300 and then i-minus natin sa purchases. And then the remainder unrealized gain, i-close natin para mawala na yung future contract receivable. Okay, so that's it. Now, let's go to option. Option is a derivative investment whereby the price movements are based on underlying, which is the price movement of another financial product. An option is a right, call option on the part of the buyer to buy at the predetermined price, struck price before the option expiration. Okay, so it is to be paid for and that amount paid is called option premium. The call option can be in the money when the underlying asset price is above the cost strike price, or out of the money when the underlying asset price is below the struck price, at the money when both are the same. So the call option is receivable from the speculator. So the difference between a future contract and option is that the holder is obliged to fulfill the terms, no? In the future contracts, while option gives the holder. So the difference between the future contract and an option is that the holder is obliged to fulfill the terms stated in the future contracts, while option gives the holder the right to buy or sell the underlying asset at expiration. So in the event that the actual market price on the date of actual purchase is lesser than the struck price, the company may purchase at a lower price and loses the upfront cash paid for the call option. Thus, the entry will involve a debit to loss on call option, an unrealized gain with a credit to call options. So let's go to our example. So illustration. On December 1, 20A, the expectation of Stanford Company for raw materials at 200,000 units scheduled to be purchased at the middle of 20B pagka following year. Okay? So in protection against the movement of prices, Stanford entered into a call option contract with a speculator by paying 100,000 pesos, no, for the option on December 120. Okay, so record the investment sa call option cash. Okay. Then, kasi December 1 tayo, no? December 120. The strike price on December 120 at 50. Yan. Ito yung basis natin. Pagka December 31, 20A, nagiging 52. Okay? And we are purchaser, no? Nag-purchase tayo. So, kung mag-increase ang price, unrealized gain natin kasi purchaser man tayo. Okay? Diba? May increase ang price. So, nakaginansya ta. Okay, kunti lang, maliit lang yung babayaran natin. Okay, ang fix natin is 50. Then, pagka July 1, 20B at 55. Okay? So, 12/31/20A. Ika ha? So, pagpalit sa option, i-record. Pagka 12/31, meron tayong unrealized gain ng call option na 300. How we get it? Kasi, December 1 man ito, no? December 1, nag-agree. Pagka end of the year, nagiging 52. So, pagka December 1, ito yung pagbili. Pagka December 31, kasi fair market value, nag-increase si call option, no? So, call option, kung 52 times nag-increase ng 2. 52, so 2 times 200 units. Nag-increase man ng 400. 400. Ang increase, nagbayad man tayo ng payment, kaya 300. Kasi nagbayad man tayo ng payment sa option. Okay? So, unrealized gain natin is 300,000. Kasi nagbayad tayo ng 100. Okay? Pagka July 1, 20B, ang price ng option is 55. So, increase pa rin, no? We are purchaser, so there is unrealized gain. So, take note yung unrealized gain nito, is component of other comprehensive income because this is a cash flow hedge. So, mas madali ang cash flow hedge, no? Compared to the katong isa, the fair value hedge. So, kuan kayo complicated. So, nag-increase ng 5, no? 55 minus 55 times 200. Nag-increase ng 1 million ang call option. Meron tayong existing dati sa balance natin, no? 1 million minus 400. So, nag-increase yung call option natin ng 600. So, unrealized gain, 600,000. Okay. So, maka-receive tayo ng cash from our call option. Our call option is 1 million, so we receive. And then, nag-purchase ka na, no? Yung purchases natin at market price. 55 times 200. So, 11 million. And then, there is unrealized mga gain. Tingnan natin how much is the unrealized gain. So, 300 plus 600. So, 900, no? So, i-close natin. Close it to purchases. So, I hope klaro yan, ha? Okay, thank you. So, hintay-hintay lang sa interest rate swap. Okay, medyo confusing siya. Okay, bye-bye.